The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, I would call the grain trade somewhat range-bound to slightly higher on Wednesday. I think it's bracing itself for whatever USDA is going to throw our way on Thursday with the September WASDE report. Well, meantime, the livestock trade found some good money flow late session to finish in the green. We saw stocks under heavy pressure early, kind of saved some of those losses as we work through the session. More inflation data to talk about, a lot of things going on. Let's put it all into perspective. Joining us here today, Mike Zuzolo with Global Commodity Analytics. Mike, good to talk with you again this week. Hope you're doing well.
Doing great, Jesse. Thanks for having me, sir.
Well, let's kick this off and maybe start with the WASDE report that's coming up on Thursday. The grain trade, as I mentioned, it felt kind of range-bound-ish on the day. We found some green numbers, but I think a lot of folks are bracing themselves for a bearish report, whether we're talking ending stocks or I know USDA is going to have some of that infield yield data here to talk about. Let's just jump right in and talk about what these ending stocks could look like in this report in general. What is on your mind here heading into Thursday's release of the WASDE?
Yeah, these are the world numbers, and we don't have time to go through both, but I can tell you that my corn yield's at 181.9 here in the States, bean yield 52.4. Got a better corn demand number than USDA here domestically, a weaker soybean demand number, mainly due to exports, a little bit due to crush. But when I bake those into the cake, it looks like to me we're about a 1.9 corn carryover. That's the final number for me. And at about a 5.13 soybean number here domestically for ending stocks. Drill that into these world numbers, and what you see on my Global Com Analytics estimates versus the lowest trade guess, I'm underneath everybody when it comes to this specific newswire estimate when it comes to my final projections. And I think this is point number one. Point number two is the big question heading into the report for me, and I did a two-part special report for clients and subscribers on the blog. First part last night. Second part tonight I'm going to talk about, can tightening world grain stocks globally, grain stocks to use levels, wheat and corn, can they keep that technical buy signal in the weekly charts? And so I'm talking about fundamentals and technicals trying to come together here with wheat the focal point, and can we keep that buy signal on the weekly charts for corn and beans alive after the report in light of the negative Chinese data? And that's what today's market talk commentary and what you and I will discuss is really all about. And the WASDE report couldn't come at a better time. It's sandwiched in between the consumer price index, which I really liked that number today because the Federal Reserve expectations have gone down a lot in terms of market expectations, and the bonds are looking at maybe a quarter point rate cut, not a 50 basis point rate cut. And that's good because that's less likely that the Federal Reserve is going to surprise us on the negative side of commodities. And so after this WASDE report comes the Federal Reserve, and I kind of can take that off my list as far as what concerns me after WASDE numbers come out on Thursday morning. So bottom lining it for me is wheat still leads to the upside, beans still lead to the downside because of these numbers, and in a stocks to use level for corn and wheat that are at or near 9 to 10 year lows for wheat and corn after tomorrow's numbers. And hopefully we see a little bit of a shaving of the bean numbers, but world stocks to use on beans still record high going back to 94.
I'm excited for this discussion today. We're going to weave all this together as best as we can here, talking some of those macro factors and more with the WASDE. PPI index will be out Thursday too, and then that's all to set up for the Fed meeting next week with those interest rates. Specifically in wheat here, I want to talk about this. You shared this headline with me, and I know that some of the rally in wheat here the last couple of sessions has been tied to dryness concerns overseas, a little bit of dryness here. I noticed these SRW futures tried to test resistance at 582 here and kind of we failed against it, but wondering if depending on what the WASDE gives us and more, if we can break through that resistance. I mean, talk about this wheat market in general and some of the positive factors that are behind it right now.
Well, this headline really speaks to the idea of why I see wheat as the leader, because wheat's been the leader to the downside. It's been the one that's come in and shut down potential rallies because of heavy, burdensome, cheaper supplies out of the Black Sea. And now we've got the Russian ag minister talking about maybe, just maybe, we aren't going to have the export market we had before. That was followed up with this Newswire story. And if you look about 2/3 of the way down, a futures trader, dealer, they call them, says, the bullish Russia headlines continue. There's crops in Kursk that won't be harvested due to too much rain in the spring wheat zones. You and I have been talking about the Black Sea for probably 6 or 7 months. And in the last 3 months, we've really been talking about drought in Ukraine and key parts of Russia. Now that's been followed up with too much rains in drier areas that couldn't take that kind of water. The same thing's going on in China right now in parts of their crop areas, Jesse. So I really see wheat as the reason why we would come out of this market counter seasonally and break free of that 2014 model. And this past week and last week, we saw it again. The beans led us lower. The beans are back in tow in November with how they traded back in the early part, going into the middle part of September back in 2014. So it's really the soybeans. It's up to them to change course, but it's got to be the wheat, I think, that does it. And if the beans are left to their own devices, I think we're going to have a tough time rallying, especially with some of these early yields coming in for both corn and beans. Last point I'll make about the soybeans and why I think they're the leader to the downside is because China's export data came out this week. A lot of their inflation data came out this week. Almost all of it points to more negative commodity demand. Yes, their August numbers were up in terms of soybean imports, but their Jan to August numbers only up about 2.8%. USDA has our numbers up 4%. Total overall calendar year numbers are only up less than 3%, with Brazil getting the vast majority of that demand. So we need a Brazilian drought to shortchange the rivers, shortchange the export market, and keep Brazilian farmers from selling more. But China is not looking pretty right now, and I think that's where the soybeans really come into play.
Talk a little bit more about that. I'll pull up on the video feed the Shanghai Equity Index weekly chart you shared with us, and let's start to tie in some of this macro picture a little bit more here in terms of the commodities. What exactly is not looking pretty right now in China, Mike?
Well, the bottom line is it's kind of like a jet airliner with two engines trying to get across the Atlantic Ocean, or in the case of China, getting across the Pacific Ocean to California. They've already lost their domestic demand because of how they've done the zero COVID policy and how they haven't stimulated their real estate market. Now they're losing their second engine in that their export market is starting to give way. That's creating an import market that is starting to give way as well. And that's the real issue. You're losing both economic engines in China right now. And the Shanghai market is now back to where it nearly was during the 2016 lows. And that's what you and I have talked a lot about, 2015 through 2019 time period. I chose the Shanghai index because we're hitting new multi-year lows. Hong Kong has not done that yet. And that's one good piece of news here. If we lose Hong Kong like we've lost Shanghai here, technically, Jesse, I think it's really going to be tough for commodity investors to come in and buy commodities. And it says this chart speaks to the Chinese deflation threat. That's really the bottom line here.
Let's compare the US dollar with the Chinese currency as well. What are you seeing on this chart that speaks to what you're talking about right now?
Yeah, this is a really nice monthly chart. We see that back in the month of August, we lost major support in the dollar against the Chinese currency as we started to see improving economic data. And now, and plus, we started to talk about the Federal Reserve changing their policy. That was really the biggest feature to this chart. So the dollar has broken its major trend line of support against the official Chinese yuan. But as you see this month, that tiny little green bar, the very last bar there, that's this month. And all of a sudden, we're starting to see the dollar gain back against the Chinese currency. That's not what we want to see. And while I'm not ready to call out the army as far as the negativity in this market, we really want to see the dollar continue to weaken against the Chinese currency, especially given that the dollar is still near a 3-year high against the Brazilian currency. So one of those two need to firm up to make our export market a lot better. And I think that's the key here at this point.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk as we're taking a look at the midweek trade and more. And let's throw another piece in here, Mike, as we think about the wheat markets and being the leader. And you mentioned the macros here, looking at some of this global economic data. Well, what about energies? Crude oil, I know earlier this week hit 16-month lows, I believe. Looking at a correlation here between SRW futures and WTI. What are you watching right now? How is crude oil factoring in here and maybe being an indicator of sorts, I would say? What are you watching right now?
Yeah, this is a common chart you and I look at with the viewers, along with the copper versus the SRW wheat. Like the soybeans, they can't, in my opinion, go up by themselves. They need the wheat and corn at this stage, especially hitting that 10 and a quarter level in lead month futures. The wheat's in a similar situation, Jesse, because of what we've been talking about. The crude oil and the copper really need to support the wheat market. Now, there is a chance, and this is where the USDA report and those world numbers we looked at really mean a lot. There is a chance for a time that the wheat market could break free from the crude oil, break free from the copper, and this, like you say, the lowest level in WTI this week since May of 2023, it could break free from that type of sensitivity with the wheat and with the copper because of the tight global stocks. If we're holding the stocks and the dollar doesn't shoot higher ahead of the election, the US presidential election, then maybe we will start to see a lot better demand base get built. And this goes right back to that Black Sea headline about the Russian wheat crop. And we can say the same thing about the European corn crop. We can say the same thing about the Ukrainian corn crop. They've been hurt bad enough that we could see the grains find support from increased demand without the macros. But this chart really does speak to the idea you can only do that for so long, and you really want both the wheat and the crude, the wheat and the copper going up together, because that brings the commodity investors in. So crude oil right now has been trading more deflation, oversupply, not enough demand. OPEC this week cut their demand versus last month for the world for 2024. That just kind of put another nail in the coffin when it came to wanting to come in and buy crude oil this month.
As we kind of wrap up the grain discussion here too, are you worried with Thursday's report of any surprise from USDA catching this market off guard? I know they're going to be, using their infield survey data along with farmer surveys, things like that. I mean, setting us up for the end of the month reports as well. I mean, are we worried about surprises here that could throw a wrench in things, Mike?
I think the biggest surprise I'm most worried about is USDA either raises yield prematurely in the U.S. crop because we're harvesting faster and they think that's going to be better. I don't agree with that, but if they would do that, I think more supply from the United States is not going to help us on a seasonal basis. So it would really make it more difficult for a counter seasonal rally and to break free from that 2014 market, Jesse. The other big thing is, are we going to see any weakening of world demand when it comes to corn, beans, and wheat because of the deflationary threat from China? I don't think that's likely because USDA just updated their ag trade update earlier in August, late mid-August. They actually increased corn and wheat, took the beans down a little bit, if I remember right. So should continue to see U.S. demand stay very, very strong in this report.
All right, let's segue over to livestock trade here, Mike, as I know we worked through Wednesday's session, kind of mixed in cattle and hogs, and then as stocks tried to kind of rally off the morning lows, we started to get some green on the screen there. Cash cattle trades maybe starting to pick up a little bit. So I'm wondering, was it a case of stocks off their lows, cash trade picking up? Did that give us some of that money flow into futures on Wednesday?
Yeah, I think so. And I think this is where the sensitivity in the cattle market, you can see a lot more in the last 2 weeks of trade with Wall Street, what's happening in the equities. and some of the macro consumer price index that happened today, it was not bearish, the commodities. It just helped us understand that the Federal Reserve maybe won't go too aggressive on a rate cut, but that's healthy, again, because we don't have to worry as much about the market being disappointed by the Fed rate cut. I think the big thing right now I'm seeing in the cattle market is the idea coming off of last week. I said to clients and subscribers, I think the packers are short bought. Their profitability's come back into the mid to high $50 per head, pretty decent cutouts right now as far as what you can make as a packer. And I think they're pretty short bought right now. And so the cash market jumping back to 182, getting away from that upper 170s level on a negotiated basis, I think made us reevaluate and look at again the idea that here we are at 175, 176 on lead month futures, while the negotiated cash is still a $5-6 premium. And I think that did find some support in the market, added to the short covering mindset, because the stock market did come off its lows pretty nicely as cattle closed.
Well, and thinking about this cattle market too, here in recent weeks, you mentioned it. It's kind of been ebbing and flowing a little bit with stocks. I think for me, the big thing I'm watching now, in lieu of not having any major holidays until we get to Thanksgiving and Christmas, you think about consumer demand and more. I mean, how does all of this ebb and flow as we kind of drift through the next couple of months ahead, and how does that impact this overall cattle market, Mike?
You hit a huge point here, Jesse, and this chart shows it. We are really searching and feeling our way through a consumption buying pattern now that the summer grilling season is over. And I think that, quite frankly, is why the futures market is holding the discount. It's holding a discount because it's more nervous that we're going to lose beef demand in the next couple months. But having said that, is there any reason to hedge the nearby? Is there any reason to hedge the fourth quarter cattle market with this kind of a discount when USDA, which we'll get fresh numbers again on this tomorrow, when the USDA is at a 190 steer price for the fourth quarter? There is no premium in the futures to hedge. So my mindset has been with clients and cattlemen is back up your marketings when we get into the 174, 175 territory when it comes to October fats and December fats, and get more aggressive and stay more current with marketings if we get back up to 178, 180, because December fats and October fats are not that different in price. Will USDA keep that 190 level for the fourth quarter tomorrow? And will the funds wake up to that and say, maybe instead of being net short, we should be net long here?
How about the hog market? What are you watching there as we work through the month of September? I feel like hogs have kind of just been range bound here. That's my feeling, though. What are you watching in the hog trade right now?
Very similar to the cattle in that the cash index at the CME is at 85 plus, while the futures here, you see lead month futures at just under 80. You've got a $5+ discount in the futures. So you don't have to be as worried about China, but the Chinese equation is a worrisome piece of news fundamentally. If they don't pull it out here in terms of recovering their economy and their consumption stays weak, I've already seen poultry prices and pig prices domestically in China in some key markets fall, and their food inflation is going up without pork because of massive flooding in their vegetable areas. So I'm really nervous about China and it creating another wave to the downside in the hog market eventually, Jesse. But for right now, like cattle, we've got a discount in the hog futures against the cash index.
All right. Great stuff. Awesome analysis as always. Let's put a bow on it here for today. Final thoughts you would share or reiterate with folks, Mike, as we head into the September WASDE and more. What do you want folks to keep in mind right now?
I'd like to see at least a neutral report, meaning no big changes from the USDA. And let's see what those weekly charts do on corn and beans, and if wheat can lead us to the upside. I'd love to see Brazil stay dry, but I don't want to have to work with that and make that the reason why the market is rallying. That will just encourage me to hedge more for both 24 and for 25. But I still think beans are the downside leader, wheat's the upside leader. Corn's still got the best fundamentals globally.
Mike, if folks want to check out your analysis, reach out for a conversation and more, how can they get in touch with you?
globalcomresearch.com. It's globalcom with 2 M's, research.com. Sign up for a 2-week free trial there.
Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, sir. Thanks for joining us here on Market Talk this week, and we will talk to you again next week.
Great to be with you, Jesse. Thanks so much.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.